Hey, this is Vic Gatto. Welcome to the Health Storm. Super excited about the talk we have today. I have Adam Dretler from Diversified Trust. Adam is a great guest. He started in the pitch in Wall Street, actually trading securities, then went to a single-family office. He now works with families across the country, helping them navigate the financial markets. We dig into my thesis about the health storm coming, its effect on the financial markets, and he talks about his view of that and how we can help families really protect themselves from this coming storm. Punchline is diversify across lots of different assets. Adam and others, but Adam is really best at it, can help you think about doing this with your portfolio. Again, Vic Gatto, thanks for watching. Super excited for the show today. Thanks, Adam. Excited for you to come and talk through this.
I appreciate it.
It's fun.
I'm excited to be here. Thank you.
So, we've known each other for a long time, but just give a little background for the audience.
Sure.
I mean, you came up through the trading markets and then worked for a single-family office and now multifamily.
Correct.
Talk about your background at Wall Street and then how you got to Nashville.
Sure. So actually, three pretty distinct roles throughout my career. I've worked at really three firms, Deutsche Bank, and then I served the Ziff family up in New York City, which was a large single-family office. And now I work at Diversified Trust, really essentially a multifamily office where we provide investment management and a large number of different services to families. In New York, where I was for about 15 years, I started my career actually on the floor of the New York Stock Exchange as a trader, as a broker down on the floor, which was fascinating.
Is anyone on the floor anymore?
I think it's no. It's
Yeah.
very much more symbolic now than anything else. CEOs go down there to ring the bell when their companies go public, but there is not a lot of open outcry trading anymore. But when I started, there was, and it was kind of a crazy environment and a fun environment to be in, and you really learned the basics of buying and selling equities,
that's
bids
like
and offers, and
hardcore, right in the pits, literally buying and selling, market
correct.
demand, market supply.
It was as physically taxing as it was mentally taxing, but it was a lot of fun, and I'm glad I had that experience. But it was time to end that experience, and I ultimately went up and worked on the global institutional trading desk for Deutsche Bank, where I was trading a whole number of different sectors for Deutsche Bank. And really that role was facilitating large institutions. So they came in and they wanted to buy or sell large blocks of stock. We would price that and then take on that risk ourselves and then figure out what to do after. How do you hedge that out? How do you unwind that risk? So it was much more transactional.
So they want to sell 500 shares of IBM.
Yeah. They want to
You
sell,
would say, I'll handle that.
Correct. But it would be
but bigger.
We want to sell 10 million shares of
Yeah.
General Motors. Where will you buy that from us? We just want to sell it, and then we'll take on that risk.
At what price will you buy it?
At what price will you buy it? And we take on that risk and then figure out the best way to unwind that. So sometimes it was easy, sometimes it was hard, sometimes you made money, sometimes you didn't.
Right.
More often than not, you didn't, because if they needed you to buy it, that means there
there's a reason.
probably wasn't anybody else there to buy it.
Yeah.
But it was a lot of fun, and you really learned a lot about risk and how do you not only handle risk in terms of pricing it and hedging it, but emotionally, how do you handle risk? You have a large position, and you learn a lot about the behavioral side of finance. Okay, I have this huge position that I'm now in charge of, and the goal is to not just panic.
Yeah.
It's to take your time and understand that there's going to be some volatility that you're going to have to deal with, but over the course of a day or a few days, how do we unwind this? So
it's interesting. Like sometimes the emotional risk is really the hardest thing to deal with.
For sure. I mean, you think about it's like things in our lives. You immediately go to the worst case at times, and then you work your way back.
Yeah.
So all of a sudden you have this big position, and you're thinking, well, maybe the stock goes to zero tomorrow.
Or what does this big institutional
Right.
trader know that I don't know?
That's exactly right. So so it was great. It was you learn a lot about yourself. You learn a lot about other people, and it was a wonderful place to start my career for sure.
Yeah.
While I was there, I actually worked quite a bit with the Ziff family office, Ziff Brothers Investments, and that was how I was first introduced to them. And
so they were a client at first.
They were a client,
Yeah.
correct. They were a big client, and would trade, and I covered them and spoke to them often, and then
and just for people that don't know, the Ziff family is one of the biggest single-family offices. I don't know if it's what level they are, but they're one of the bigger ones.
It's a large single-family office based up in
two
New York
brothers.
City. Three brothers.
Three brothers.
Three brothers.
Yeah.
Wonderful amazing, thoughtful people, and I was very lucky to have the opportunity to work there after my time at Deutsche Bank.
Yeah, so you went from trading to block client services, institutional services, to working for the Ziff family. What was your role there?
Sure. So I kind of flipped with regards to at Deutsche Bank. I was speaking to all of the different institutional clients, and then when I worked for the Ziff family, I became one of those institutional clients. So having that background of kind of what's going on the other side of the phones was really important. One of the bigger differences is you're serving a family, and so really learning about what the family was looking for, understanding the family. What I was doing was just one piece of a much larger puzzle that they were putting together. And it was fascinating to be able to have that experience. And I think
your time horizon, at least the flexibility around your time horizon, can be different.
It was a massive advantage.
Yeah.
The time horizon arbitrage is a huge deal, and having the ability to have no outside investors and having it be one family's capital makes it a very unique experience.
Yeah.
And there's a lot of things you can take advantage of, and you learn a lot when you're in an environment like that. And it was such an interesting place because the finance part was obviously important and the investment part was important, but back to the psychology component of it, that was a huge part of what we all studied and learned and tried to become better at.
Okay, so the move to the Ziff brothers must have been quite a change. Yep. What was the scale of the operation? About 100 employees?
It was a very large single-family office based in New York, much like the families we serve at Diversified. There's a lot of confidentiality around that, but a big family with global operations, doing a lot of really, really neat things on the investment side.
Yeah, so much more complex than a lot of single-family offices. Lots of activities, lots of strategies, and people working on stuff.
That's exactly right.
Yeah.
And they had employees all over the world, which was fascinating to be a part of something like that and that size and that scale. And it was a very, very unique experience. I don't have, like many family offices, they're very private, and so I don't have a lot of insight into how other family offices work and what the size and scale is, but this was a pretty special.
Yeah, that's probably one of the things. It's sort of a cliche, but if you've worked with one family office, you sort of know that family.
That's right.
And not anything else.
That's right. And that's what's fun about the family office space, or the multifamily office space. Every family is different.
Yeah.
And a single family office could be a few employees, or it could be 50 or 100 employees or more. And so if you've seen one family office, you've seen one family office.
Yes, right. So shift to Diversified, where you are now. Sure. Quite a change. You went from single family to multifamily.
Correct.
Now.
Yeah.
How's that different?
It's a lot different. I think
and New York to Nashville.
And New York
is a little
to Nashville.
Different. Yeah.
So to go back, so was in working for the Ziff family, and then met my wife, who you know, and I joke around that I woke up here one day soon after that. But
I say our wives are similarly strong. It's a democracy. She gets 4 votes and I get 1, and then we see who wins.
That's right. Yeah. That's about right. I wonder if I actually get 1 sometimes. but no, we moved to Nashville about 6 years ago, and I looked at a lot of different opportunities. And actually, when I met our founder, Bill Spitz, who you know and who was very highly regarded in Nashville, it was very clear to me that it would be a wonderful place should there be an opportunity there, and there ended up being one. And so that's the only place I've worked since I've been here. I've been here about 6 years, and it's been wonderful. Biggest difference is going from working with one family, where you really get to know that family and understand what their goals are and what they're looking for, whether it's what information they want on a day-to-day basis, to working with lots of different families who all have different personalities. And so I think understanding the individual and the family is as important as investing, quite honestly, in what I do. And so I think the people that are able to do what I do and what a lot of people do, to do that well, you have to really be able to get to know people well and build a deep, meaningful relationship with the families, because you become a big part of their life. And every family has different personalities, and every person within that family also has different personalities. So you could be speaking to one person in the family and then have a conversation later with a different person in the family, and they could be very, very different conversations because their goals are different, what they're looking for is different. they're
And so you need to be much more flexible or willing to or able to work with different type families. We're working with many families as opposed to just the Ziff family.
That's right.
To meet their needs, whatever those needs are.
That's exactly right. So there's, I feel like the EQ side is equally, if not more important, oftentimes in what we do. So it's great though. I mean, we get to talk to really wonderful people and help them navigate all the financial areas of their life, and sometimes the non-financial areas as well, which is neat.
Yeah. Well, as you know, we're here to talk about the health storm, and I have a pretty bold prediction. I almost scared myself when I first started talking about this, that there's going to be a pretty massive change coming to health and healthcare in the next 3 to 5 years, and that's going to not only really disrupt the health market, but the economy overall, and in fact the stock market. And so the scary part of the prediction is that I think the U.S. equity markets peaked, in December recently, and we're going to be flat for a while, and then not flat, down for a while. And so we're going to dig into that. But are there any sort of quick things that you want to talk about before we dive into all the details of it?
Sure. That is a bold prediction. I agree with you. It's.
You agree that it's bold, or you agree that it's right?
I agree that it's bold. I don't know if it's right. I think obviously none of us know, and I'm not intentionally dodging the question. I think it's an important thing to think about. I think it's hard to imagine a decade similar to the decade that we just had.
Yeah.
I think a little bit more in market cycles, and that's arguably not even a market cycle because we've only seen the market move in one direction.
Right.
So I agree with you that we have come a long way in the last 10 years. There is a fun adage that bull markets don't die of old age. And so, I think if somebody were to wake up out of a 10-year nap and not have seen what the markets have done, and we're able to just focus on the economics of the global macroeconomics and microeconomics and where interest rates are and where unemployment is, it would be interesting to see what their view is. And I think that's really what the skill that the best investors have, is that they're able to remove what's gone on the last 5 years or 10 years and really look at things as a snapshot, but it's impossible to ignore where we've come from. So I think we've had a huge move, and it's whether we have whether there's a large recession looming. I don't think that's necessarily the case, but I do think that volatility in the future has to be expected.
Yeah, so there's two sort of core assumptions that underpin my bold statement, right? So the first one I spend a lot of time thinking about, which is this health storm. The entire podcast is the health storm.
Right.
This health storm is going to come sort of sweeping through, almost like a hurricane coming. You can see it off on the horizon, and it's coming. And what we're trying to do at Jumpstart, and what I want to do with you for a minute, is to sort of try to be predictive about what could we look for first that would be indicative of what's going to come later in health and healthcare. Mm-hmm. And so there's really 4 broad trends that I think are leading to this. Okay, so health, we're here in Nashville, really the invention place of for-profit healthcare 50 years ago.
Sure.
And so for the past 50 years, there's been this move from kind of care by government or by charity to care much more efficiently by for-profits. And the for-profits, even if they don't do all the care, they're driving the market and making it more efficient. To me, that's the story of Nashville the last 50 years and the story of healthcare the last 50 years.
Right.
I think that story is changing. And the next few years is this storm. Mm-hmm. And then, storms come through and they cause some destruction, cause some disruption, and then there'll be green spaces, opportunities for new ideas to blossom. But that's going to be not for a while. The first part is the storm actually hitting.
Right.
And so the 4 trends that I see that I want your take on is the rise of the consumer is the first one. So I think consumers, our wives and our parents and our kids and people around town, they're taking control of their own health care. They are searching on the internet and then coming to their doctor saying, I think I have this and I want this treatment.
Right.
It's no longer sort of I'm passively waiting for the man in the white coat to tell me what to do.
Right.
So that's the first kind of big trend. The next is, I think, care is moving out of the hospital into the neighborhood or the home. And so there's less and less that's needed to be done in the hospital. And you can do it cheaper, easier, more effective, more convenient for me outside the hospital. There's tech tools, data science, artificial intelligence, telemedicine that are driving changes in healthcare. And then there's market entry. So we have Apple, Amazon, Google, Walmart jumping into healthcare who have not been in healthcare previously. These trends are really going to change the landscape. And I want to get your thoughts. You spend a lot of time in financial markets, but you live here in Nashville, and
Right.
I would guess several of your clients are in healthcare.
Correct.
And so give me your impression of those trends.
Yeah, I think, not being the healthcare expert, sitting with someone who is much more of a healthcare expert than I am, I agree that the pace in which the healthcare landscape is changing is a pace that's never been seen before. And I was actually speaking to a very, very thoughtful, knowledgeable friend who works in the public investing space focused on healthcare today.
A lot of shorts.
And he just said the exact same thesis that you have, that the amount of disruption that we're seeing now and in the next 10 years is unprecedented. The amount of change that we're seeing and that we will see in the next 10 years is unprecedented. And as a result, the opportunities that we will see as investors, both public and private, is unprecedented, similar to what's gone on in technology the last 10 years. And I think technology is obviously a huge part of what's going on in healthcare. So at a higher level than you went at it, the pace at which things are changing, the disruption that's going on, the access of information that we as patients have is creating a landscape that people are still trying to figure out. And to your point, my wife can go Google what she thinks she might be experiencing, whether she has pain in her back or maybe she has a headache or a stomachache, and start to gain some understanding or at least beliefs of what's going on. And then I think the demands that consumers have on pace in which they get care. I mean, we are in a society where Uber and Amazon and immediate gratification rules all, and everything comes directly to you. So I think that's changing how people are thinking about their own personal health care.
Yeah, and I think there's two sides to it. There is it's going to be wonderful as a healthcare consumer, right? More choice, more convenience, lower costs, better outcomes. Of course, I want that.
Right.
And so that the good side of it is that as these trends play out and new players come in and they bring great products to healthcare consumers, that would be wonderful. At the same time, health employs about 13% of the workforce, and the industry, in order to drive lower costs, is not going to use as many people.
Correct.
And so we're going to have a massive sort of workforce transition.
That's right.
And in the rural community, or not even rural, but just less ex-urban, a lot of the employee base is working in mid-level jobs in hospitals.
Right.
And that's going to be a very difficult transition for our economy. And so it's a great product and great solution, and yet I think it's going to be a struggle to sort of get through, and it's going to drive challenges in consumer spending and challenges on other spaces.
There's going to be some unintended consequences that we haven't thought of yet that are going to certainly be challenging for the economy.
Yeah, so part of my prediction is that there's 5,000 hospitals in the country. I think 1,500 close in the next 2 years, because they're running at sort of a 2-3% net margin today, and reimbursement's coming down, and there's pressure for market entry, and they're not going to be able to survive. And it's not the cream of the crop for-profit sort of in the big urban centers. It's going to be the small community hospitals that are not as well capitalized, not as well run, don't have as much negotiating leverage, and yet they are a third of the employee base in this small community. So what are all those people going to do?
Right. Yeah, it's a huge problem, and and we're seeing it in a lot of industries. Technology is disrupting a lot of industries right now, and I think that's going to be a huge challenge for the economy to swallow that level of increased unemployment.
Yeah,
that looks like we're about to face, and as an investment firm, we think about healthcare as well and how it's changing how we're thinking about investing, because you think about all of the wonderful healthcare technology and what that's doing to life expectancies and longevity. All of a sudden, the average age of the families we serve is increasing, which is wonderful, but the portfolios need to sustain that spend for longer.
You need to be ready to sustain that generation until they're 90.
That's right.
Or 95 or 100.
And so when we're helping with planning, you could be a very successful person. At 65, you still have, hopefully, a long way to go in your life. Or 70, you have a long way to go.
You might have 30 years.
Yeah, and so having a portfolio sustain that spend, similar to how an institution thinks about it, sustainable spend. We need to be thoughtful and really think about what the goals are, and really be thoughtful on the planning side too, to help educate families on, we know that you've done well and you've had a wonderful career and you're thinking about retiring, but let's work through some of the numbers, because hopefully you're going to live for a lot longer, and we need this portfolio to allow you to do that.
Yeah. Well, so I think that's a good segue to the second big sort of pillar of this concept. So the first is that healthcare is going to change dramatically. The second is that the boomers are, they have been the biggest investing force in the history of the planet. And as they age, they're no longer buying 100% growth equity.
Right.
Eventually they're going to have to shift out into dividend-paying stocks or bonds, if they can find any yield in bonds. Right. And that is going to cause what I call it's a funds flow reversal. The boomers have been in their high earning ages for the last 40 years. Right. And that's been extended because people can work longer, but as they get to be 75, 80, they're not going to generate income, and they have to then start selling out of things.
Correct.
And so as that shifts and trillions of dollars shift from growth to more conservative or even come out of the markets,
sure,
what's going to be the impact? I think it's going to be part of this sort of peak equities now declining for a few years.
Right. I think obviously the search for yield is something that everybody is thinking about right now. And it's a needle that's tough to thread, because everybody wants growth, but at the same time they also want protection. And while bonds provide little in terms of yield, they do act as insurance in a portfolio. And so
it feels a little bit like a game of musical chairs to me. Like no one wants to sit down too early.
That's right.
Because they're not going to get the growth. But I think there's a threshold where if bonds get to, certainly if they get to 4, right, people are going to quickly come over and I'll lock in 4.
Right. Which is
and then
amazing to think that's the number now.
But then that's self-fulfilling. Then as people do that,
right,
then equities are not going to grow.
That's right.
And so you don't want to be late to that party. Mm-hmm. That's why it's musical chairs. So
right.
Then maybe if I think people are going to go at 4, I may sneak in and start hedging in there at 3.
Sure.
And so you're the expert in this space, but that's.
I think I think it's very hard to get that exactly right. It's impossible to get that exactly right, and I don't think anybody can get that exactly right, and I don't think anybody that's a thoughtful investor thinks they can get that exactly right.
There's no reason to try to pick it.
The key is to figure out the right mix, and it's not going to be all one way or all the other way, but figure out what the right mix is for your personal situation. I think that's the key, is understanding what your personal situation is and understanding what your personal goals are. And we think about that a lot as a firm, and when we talk to families, yes, of course we want to outperform specific benchmarks and things like that. But when it really comes down to it, are you living the life that you want? Mm-hmm. And are you being thoughtful with how you're spending? And are we being thoughtful in how we're deploying? And for us, if we can get a really good handle on what you need this portfolio to generate for you. How much work does this portfolio need for you? We'd like to take on the least amount of risk we possibly can to get you that return. And so it is a circumstance where every family is different. I think one thing we will see, and you brought up the baby boomers, the access to alternative investments is something that everybody is going to be seeking and now have access to. And I think illiquidity is something that more and more families are going to be looking to take on because you should be able to generate outsized returns with illiquid investments.
Yeah, so that's where I get to, is that the public markets are going to be a challenging place to be in the next few years. Now, whether that's immediately, like today is the top,
correct,
or it's sort of a little
later
on.
First.
Right, you heard it here first. So what's the date? Yeah, the date and time. I think that the answer is you need to consider illiquid or diversification into other parts of the market, at least to hedge that better, offset that. Correct. And it's really not important if the peak is today or next year or I've already seen it, but the point is to sort of diversify across that.
We would agree with you completely, and I think we've seen that, and we talk about the endowment model. We've seen that for a long time, and the ability for alternative investments or liquid investments or private investments to help carry some of the load that the public markets can't. I think what's different now is that 20 years ago, people didn't necessarily have access like they do now.
Yeah.
And so with access, people are looking for the best vehicles to take advantage of. And so, I think you need to be thoughtful on how you're diversifying your portfolio. You need to have exposure to a lot of different asset classes, and you're not going to get the timing right on when you make those tilts and pivots and shifts, but you need to know that that change is coming, and you need to be thoughtful about that.
So I want you to talk about two things. One is part of the reason I wanted to have you on, and I'm excited about talking to you, is the mutual fund industry or the Wall Street broadly, they are selling typically long-only product. And so if I'm a guy that's commissioned selling long-only product,
right,
I don't like these two theses, right? Like that doesn't help me pay my kid's tuition bill.
That's right.
And what I think is interesting is to have Diversified on where you can play both sides of the market. You can play all kinds of market environments, long and short and neutral.
That's right.
And that allows you to be much more thoughtful, much more open to, well, let's look at lots of choices.
That's right. That's right.
That not, other, I don't want to name any names, but other platforms that don't have those opportunities, they're not incented to talk about. Really.
That's right. No, it's important to have a lot of tools in the toolkit.
Yeah.
And we don't need to necessarily use all the tools. And again, I will harp back to, I don't think more complex is better. But there are certainly vehicles out there that we're thrilled to have access to as a firm that we think can add some alpha to one's portfolio. Not all of them perform how we want. It is investing. But I think knowing that there's access and there's deep relationships that the firm has that gets us that access has been important.
Yeah, so I just want to be very clear. So if you are with a firm that has only liquid, long-only solutions, it's too much risk. That's what I said.
Right.
You don't have to say that exactly. I think that's the lesson I take away. Now, even if you don't choose to access all those, it's undue amount of risk to not have the choice.
I think people have short-term memories, and if we look at the last 10 years, someone would easily be able to debate you on that. But I agree with you that you need to be prepared for large downturns in the market. It is going to happen. I don't want to be naive I don't want to be naive and think that I could predict that or any of us can predict that. But you need it's a when, not an if. And I think you're exactly right that if your portfolio is built on pretty straightforward liquid long-only vehicles, you've done great. For the record, you've had a great decade.
Yeah, congratulations.
That's great.
Get the hell out.
Right. You've had a great decade, and that's wonderful. again, I think managing volatility in a portfolio is incredibly important. And we've done a lot of studies. There's a great one that I don't have any information on right here, but I know the numbers. There was a 25-year period where if you had a 80-20 stock bond portfolio and you had the exact inverse, you almost had identical returns because of the enormous bull market we've seen. But when you look at the volatility of those portfolios, obviously an 80% equity portfolio had much more volatility than a 20% equity portfolio.
You lose more sleep and
so
you get to the same place.
And actually, when you're in what's so important for families that are relying on portfolios to sustain a lifestyle or an institution, when you're drawing off those portfolios, at the end of that race, you've actually been able, say you have a 5% spend, you've actually been able to take out more money from the low volatility portfolio compared to the high volatility portfolio. And at the end of that 25-year period, you actually had more money. So you think about building.
And that's with a crazy bull market that we've had.
That is, So that is that was from, I think it was 1990 to 2015 maybe were the years.
Yeah, probably one of the bullish periods of time in the history of the world.
Yeah, I mean, and so there's a lot of metrics that go into what's a successful portfolio. And again, it goes back to what the goals are. If you can close your eyes and just not look at it for 50 years, then you're probably okay taking on a lot more risk if you truly believe that you can close your eyes and not look at it. But managing that volatility is incredibly important with portfolios that money is being taken out of. And we spent a lot of time thinking about how do you do that, and that goes right back to your point of it's very difficult to do that without some very thoughtful strategies in there that are different than
most families where there is an elderly generation who aren't working anymore are taking money out of their portfolio to live on.
That's exactly right.
You've mentioned access a couple of times. I mean, I in the venture world, which I live in, access is like the first, second, and third most important thing. Like it is access. You either see the best deals and the entrepreneurs that are really good want you to help them, or you don't make any money.
That's right.
That's sort of the venture model.
Right.
And you mentioned people now have access to lots more tools.
That's right.
When you say compared to when, so when you started in the business, what was it like, and where is it today?
Well, I think about all the private deals that people see and send to us to look at for them. When 20 years ago, when I started to do this, I don't remember it being like that.
Yeah, I think it wasn't. I mean, there was very few amount of hedge funds out there 20 years ago.
That's exactly
and
right.
they weren't open to the general population. They weren't open to the really wealthy population. They were only open to institutional investors who are huge.
Right.
Yeah.
And so I think there's I think the space you're in is probably the most impacted by access. I think you look at the public markets, it would be unfair. It would not be realistic to think that a firm like ours has any access that a lot of other firms have out there in the liquid space. I think in some of the illiquid spaces, maybe that changes a little bit, but I certainly think in the private equity space.
Yeah, but I think what Bill started with Diversified that you're carrying forward now is bringing access to this portfolio of great and highly diversified asset pools to smaller institutions or families, not necessarily multi-billion-dollar endowments.
That's correct. And that was when Bill left Vanderbilt. He was there for 20 years and had an incredible success while he was there. The reason Diversified Trust came to be 25 years ago is because Bill and some very thoughtful colleagues, other co-founders, but there was a lot of people going to Bill when he was the chief investment officer of Vanderbilt.
Yeah, saying, tell me what to do.
Yeah, we are a mid-size institution and we want to invest like Vanderbilt, or we're a large family and we want to invest like Vanderbilt or like Yale, or pick a very thoughtful endowment. Right. And so that's where the firm started. And so that is at at its core in our DNA.
So talk about the endowment model, which you mentioned before. What do you mean by that? What does that involve? Why should a family consider, or an individual consider, trying to do that?
Sure. I mean, I think there's various definitions, but an endowment model is a well-diversified portfolio across multiple asset classes, with I'd say a sizable portion of that in historically what is called alternatives. I think that term is sort of going away a little bit because private equity is it used to be stocks and bonds and everything else. I think private equity is not really an alternative investment anymore.
It's almost core.
And we've talked about this. Private equity is equity exposure. It has an equity beta. It smells like an equity, and it sounds like an equity, and it acts like an equity. And so just because it's illiquid doesn't mean it's an alternative. And so I think that's actually an important point that we've done a lot of work on, is when you're thinking
there's two axes, right? There's alternative and traditional,
right,
and then liquid and illiquid.
That's right. And when we think of alternative, we use a term called a diversifier. We think more of an uncorrelated vehicle. So there's a lot of uncorrelated vehicles that would more likely be bucketed into that alternative piece. And so the endowment model is taking a lot of these different types of investments and putting them together to build out a portfolio that is looking for growth, but is also very thoughtful with regards to protecting the downside. And you think about a Vanderbilt or a nonprofit who is relying on this portfolio to fund their operations. It's incredibly important to make sure that you're building a very thoughtful portfolio, because a family can not take that vacation if they want to, but an
institution needs to pay the bill.
You can't not make payroll.
Yeah.
And so it's incredibly important to be thinking about that.
And so you set up a widely diversified portfolio, liquid, illiquid, traditional, diversifiers.
Correct.
And it should provide some cash each year for operations in an institution, or for living with a family.
That's right.
That's kind of broadly an endowment model.
That's broadly the endowment model. And as you've mentioned, we're in a challenging environment where you have a market that's debatably overextended, and so are we going to get more growth from the public equity markets? Who knows? But we've certainly come a long way. Bonds get you very little, and so to achieve that spend, there needs to be other vehicles in there to get you there that are non-traditional, and I think that's kind of a core element of that endowment, is the non-traditional components.
Yeah, so one of the things I want you to talk about, because you really taught me this, is people spend a lot of time thinking about manager selection. Who am I going to find to manage my real estate,
right,
or my venture, or my whatever, international equity, something?
Sure.
And that is a consideration, but you taught me, I want you to teach the audience that the asset allocation question is probably the first thing to think through. And then based on which asset, you have some good studies. I think we have a slide to show about sort of when managers matter and when they maybe matter less.
That's right. I think it obviously all matters and everything is going to move the needle, but we oftentimes spend way too much time thinking about the actual manager we're using versus how much we're actually allocating to that manager. So the slide talks about the difference between the top quartile and the bottom quartile for U.S. equities, international equities, corporate bonds, and then it talks about the private side, so buyout and venture. And when you look at the data, the difference between the best corporate bond manager versus a lower quartile bond manager.
Right. So we'll put up on the slide on the screen, but on the left, as you're looking at it, what is this right here that has almost no difference?
So you, based on this data, you look at corporate bonds, and the spread between the upper quartile and the lower quartile, as you can see, is 70 basis points.
Right.
It's virtually nothing. And
I don't really care where I am.
So you don't really care where you are. You just need that exposure, and it's more of how much do I put into corporate bonds? What percentage of my allocation is ultimately going to go to corporate bonds? And then you move.
So as you go across, what are the different categories?
So this slide in particular talks about corporate bonds, U.S. large cap equities, small cap equities, going from left to right, international equities, and then we move into the private equity world, and you can look at buyout and venture. And so certainly the spread widens a little bit as you would as you would imagine, as you go from a little bit more difficult asset classes to navigate, certainly corporate bonds versus international equities, there's a difference in
there's some more work in there.
That's right. But even international equities, we're not looking at a huge spread between top quartile and bottom quartile, but then you look all the way to the right and you look at buyout and venture, and being with the best managers really matters when it comes to that. And you can see a huge spread there. So the way we think about it is, yes, it's important to have great managers, but the more important decision is how much you're allocating to each asset class, because roughly, there's a lot of different data out there, but roughly 90% of a portfolio's returns come from your allocation at a higher level. How much is in U.S. equities versus international equities? Yeah. So I could have the best international value manager out there, but if my allocation to that area of the market was more than U.S. large cap or U.S. value,
that wasn't good.
I would have underperformed very dramatically. So
even if you're with an index fund or something in the U.S.,
I could be in just own the S&P 500, just own the ETF. I would have done much better over the last 10 years than the best international large cap equity manager. So how much you're putting in each bucket is much more important than the manager you're using at a higher level. It all adds up. So it's all really important stuff, and we spend a lot of time on all areas of that. But this slide is a pretty powerful one when you're thinking about how you're allocating a portfolio.
Yeah, and then as a VC, I like this slide.
This is a beautiful slide.
Actually, I can invest time and it makes a difference for me.
Vic is way up here on the top. No, it is.
Right.
It's and it also shows you how painful it can be if you're wrong, which is just as important.
Yeah,
if
you
not
don't want to
more
be in a
important.
bad VC.
You know, if you're in a bad VC, you
might
could
as well
have
just put money in the wastebasket and let it fire.
Yeah, it can be a complete loss of capital. And so so we think about this a lot. And when you're building and you're allocating portfolios, how much we're allocating to each asset class, we spend a lot of time thinking about that.
Yeah, so talk through, if I'm a family watching this, what does Diversified do to help me navigate this process from, okay, I'm long only and I set it and forget it.
Right.
And that's been good for the last few years, but how does Diversified teach me how to approach this and then walk through the process that you go through?
Sure. There's a lot of conversations to begin with. I mean, it does all come back to what are the goals of the portfolios. Some are to sustain a lifestyle. Some it's generational wealth that's going to be handed down. And so you're building very different portfolios depending on the goals. But at the beginning, it's really just taking getting a comprehensive understanding of what you have currently, which a lot of people.
So when you first come in, you're more just trying to understand what are their goals and what do you have today.
That's exactly right, and that takes some time. I mean, it takes time to unpackage all that, especially with big, complex families that have been at it for a while. There's a lot to understand and digest. So once we have a really good understanding of what's there, we then really try to focus on what are the goals of the different pools of assets, because rarely is it just one account, one family with one pool of capital.
They have a trust for the kids.
That's right. And there's some longer term portfolios. There's some trusts. There's some portfolios that are there for maybe more near term spending, but they don't want it to just sit in cash. So really understanding what the different pools of assets are is incredibly important. And then you really try to get to understand what each family's risk tolerance is, because everybody's different, and we are there to hopefully help families sleep at night. We want people to be organized. We're able to help on tax and financial planning. We do a lot of risk assessments for families. We're a trust company, so we serve as corporate trustee, and we help think about estate planning. And of course, building out portfolios is a big part of what we do. But we want people to not worry about their assets or what their portfolios are doing. So we want to take that burden off their shoulders and really come in and become their family office for families that aren't like some of the the ultra high net worth.
Yeah, there's some threshold where you have a lot of money, lots of family members. You should have your own office, but you can be very large and not need a family office.
That's exactly right, and that's a big change in the landscape right now. Is there are a lot of firms out there, Diversified Trust, obviously where I work, but I think there's a lot of thoughtful groups out there that can handle that. And so the number...
Yeah, I mean, Diversified is number one, clearly.
Right.
But there's
Right.
there's a few others.
No, so the number, whatever the net worth of the family, I believe, and I think it's a trend in the industry, to open up your own single-family office, the costs don't necessarily justify it anymore for certain wealth. And so I think that number is growing and growing with the capabilities of firms like ours to be able to do all of those things that a family office would do. So that's fun. That's fun to be a part of. Yeah,
and then you can work with families and you work with fund managers like me to get them access to the best funds out there. Right? So
we hope.
There are places where it doesn't matter and you should be with an index.
That's right.
But then in venture, I mean, we work hard to get access. And really, healthcare is, as we talked about earlier, changing dramatically.
Right.
Huge regulatory kind of burden and overhang. And it's really important to know where you're investing and how you're going to sort of execute that.
That's right.
And it's, I think, valuable for a family to sort of understand from you, how do I map this out, and then work with sort of VCs and buyout and alternatives and any of the illiquid classes have more difference between top quartile and
That's
bottom
exactly
quartile.
right. And so we help. We have managers that we use that we think very highly of.
Yeah, and you can do due diligence on firms.
And we can do due diligence. We have families that say, well, have you heard of this group? What do you think of this group?
Yeah.
So we can help. We can help on vetting those sort of situations. So we really hope to be the quarterback for a family's financial affairs. And when something happens, we're oftentimes the first call, whether it's something good or
Right.
unfortunately something that maybe isn't so good.
Yeah, we sold this asset for 4 times what we thought. Super exciting.
That's right.
Or we have a lawsuit, and do we have those trust things set up?
That's right.
And either side, they're
That's
calling
exactly
you.
right.
Yeah.
And I think the investing side, which is what you and I focus a lot of time on, is incredibly important. But all of the other things that we hope to provide families, I think are equally important. You just mentioned setting up trusts. Is your estate really well structured?
Yeah.
Do my documents say what I think they say with regards to transfer of wealth, or is my will thoughtfully written, or I have all these properties and I have insurance and it's a buddy that's been my insurance person and they've done a good job, but maybe it's worth having another set of eyes on that to actually make sure. So just
maybe my
all those
fraternity
boxes.
brother that I hung out with and drank beer with 40 years ago isn't the best guy to manage my estate planning today.
Perhaps.
Maybe he is, maybe he's not.
Or maybe he is, or our job is, we have CPAs that work at the firm, we have lawyers that work at the firm, but we're not doing tax returns. We're not writing trust documents. And so we're able to look at all these things and then say, go back to your buddy and say, oh, this is, I had somebody take a look. Can we make these changes?
Yeah, right.
So
right.
we're not trying to disrupt those relationships. It's just important to have another set of eyes on it.
Yeah. Okay, so there's a ton of information. I feel like the pace of news and change in information every day is accelerating.
Yes.
How do you keep abreast of all this? How do you recommend that other people keep up with this stuff?
Sure. I mean, the noise is something that when working with the ZIFs, that was a topic that was talked about a lot. How do you screen out the noise? And I think the first thing is to not look at things day to day or week to week or month to month or even quarter to quarter at times with regards to your
portfolio,
investments,
your holdings. Yeah.
Because it's a long-term race.
Yeah.
With regards to digesting information, I think it's important to look at both sides of debates, quite honestly. I like reading material on why this bull market's going to continue for another decade, and I love reading things on why today was the top.
That's interesting. So I was with my 2 sons, as you know, but for the audience, they're 13 and 15 last night, and we turned on the news, and Fox News has really skewed kind of pro-Republican stuff. And so my son said, is that really right? And I said, well, it's right, kind of. It also is slanted. Mm-hmm. And then we flipped over to CNN, Right. And my audience has people from both sides. CNN is as extreme.
That's right.
The other way.
Right.
And so you sort of have to be watching both at once. And
I
same
agree.
with Bull and Bear. You have to be balancing both at once.
It's really hard. I mean, you look at the environment we're in. We're not going to get obviously into a political discussion here.
No one is a centrist, right? Like
we're very
everyone's
barbelled.
extremist.
We're
right.
incredibly barbelled right now, and that makes it really difficult to understand what's right, what's wrong, what's real, what's not real.
Yeah. The nice thing for me is every politician who could possibly be president, healthcare is their top issue.
That's right.
And they want to change the system. And so that's good. It's great for me.
That's perfect.
No matter what, it's
You're looking for maximum disruption.
Yeah, that's right. That's right.
It's exactly right. So yeah, no, I think reading a lot. I think talking to a lot of people. I spend a lot of time just reaching out to people, talking to people about what they're thinking, what they're hearing.
Yeah, and trying not to lead the witness. Just
That's
like,
right.
What do you think?
And I think I'm lucky to have a lot of relationships from my previous life in New York, where there's a lot of smart, thoughtful people there that I really lean on. I have some mentors who are wonderful and who I can talk to and get advice from. So I think it's building relationships. It's reading. It's being open-minded. It's not.
Yeah.
It's not just taking positions and then not listening to what the other side has to say, because people are really passionate right now, and that's great. But you need to also be open-minded.
Yeah. And so if someone's watching this and wants to learn about private illiquid markets or the endowment model, is there something on your website, or is there a book or information that they can dig into?
Sure. We have information at Diversified Trust. There's also a lot. The internet is an amazing place. You can go on Harvard Business School's website and get access to great things. Kellogg has great things. There's a lot of wonderful educational institutions that just publish this
so
stuff
if
now.
people put endowment model or
right.
diversified trust or alternative investing, they'll get a ton of information.
You'll get a ton of information. And you'll be able to read about it. And I would say go talk to people who have been doing it. Call, go talk to Bill. He's a wonderful resource. Go.
Bill Spitz.
Yeah, Bill Spitz. Go, if you're local, go. If you're in Nashville, go talk to some folks at Vanderbilt and see how they're doing. And I think one thing that I realized, maybe I was a little jaded up in New York City, but at least in Nashville, if you're thoughtful and you reach out to people in a thoughtful way and you really just want to pick their brain without an agenda, you can get a coffee with pretty much anybody you want. And that's a fun thing.
In sort of every zip code except for like 3 or 4, New York City, Manhattan being one of them, you can pretty much reach out to people and schedule it, but have a conversation and try to learn.
No, and I think that's so important. I think it's so important to have the conversations. I had one this morning with somebody, with a friend that and you learn. You learn. I mean, healthcare is not my expertise, but I'm in a healthcare city, and so it's really fun to sit down and talk to you or talk to other friends that are in this business and in this industry, because you pick things up every time.
Yeah.
I think it's reading, it's going to conferences if you really want to dig in. There's so much access to information now. I don't think it's how do I get it? It's how do I sift through which one's good and which one's bad.
Yeah.
So there's a lot of ways to do it, and I think you can, to your point, you can Google it and find pretty much whatever you want.
Yeah. Good. So with all my guests, I have a series called "Wish I Knew." So the setup is, when you started, which was 99, 2000, 99. What do you wish you knew then? That you know now.
I've thought about this a lot, and I think it's not even close. The value of relationships, to me, is without a doubt absolutely the most powerful currency we all have. And I think when you're younger, you don't necessarily think about it that way. You're starting your career, you're grinding it out.
And you're sort of been in schools and undergrad, grad, and it's all about sort of what you know or can prove you know.
That's right. And you're thinking very day to day. And I think back to the biggest difference between my first job and the job I have now is I'm thinking year to year with regards to a lot of the things that that are bouncing around in my head. And so building relationships with people and being really thoughtful about it and getting to know people and reaching out to people is so valuable. And there's a lot of families that we work with now that are relationships that I had from 15 or 20 years ago when I wasn't even in a position to be doing what I'm doing now. And
and there's something about sort of treating people well and being intellectually curious and taking.
That's right.
Then when you change jobs and you're in a position to help them,
that's right.
They remember that from the
That's
past.
exactly right. I think this goes without saying, and hopefully my kids watch this someday, and maybe your kids will. But
I will send it to Julie.
Being thoughtful all the time,
yeah,
is so important, because I forget, I'm not going to get this exact quote right, but the same people you see on the way up are the ones you're going to see on the way down.
Yeah,
and so the world is a very small place now, and people can reach out to 1 or 2 degrees of separation to get a opinion on you, and if have not been thoughtful, if you've been a jerk to somebody for no reason, or that's going to come back. And so you just be thoughtful all the time, and get to know a lot of people, and really focus on building those relationships. And it takes work. Going to grab a coffee with somebody is great, but 3 months later,
you have to sort of follow up.
You have to follow up, and you have to be intentional about it, and meeting a lot of people, and learning from people, and getting to know people, and helping people. There's a compounding effect in investing. Einstein says the 8th wonder of the world is compounding. I think it's the same thing with relationships. I really do, and I think building those relationships, and the more people you get to know and understand and learn from. It only helps, and it might not help you professionally necessarily, but it'll help you personally. You'll become better, and in the long run, it'll just make things. It's just a wonderful thing.
Right. Well, Adam, thank you for doing this. It's been
my
great.
Pleasure.
And
it's fun.
I'm excited to sort of see how it all plays out.
Yeah, I'm excited for you. Congratulations. This is awesome.
Okay.
All right.
Thanks.
Thank you.
Appreciate it.